A client of mine recently generated $153,611 in profit, not through luck, not through guessing market direction, and not through manual trading. These results came from a fully automated trading system built on the same structural principles that institutions use to deploy 6 and 7 and even 8-figure capital every single day. So in this video, I'm going to break down exactly why systems like this work, what separates institutional trading from retail speculation, and how these same tools, once locked behind Wall Street, are now accessible to individual investors who understand risk and structure, and how this client of mine got these exact results. This is a post he shared inside our private community. I was inspired by another member and closed out my 4-hour bot a little bit early, just over 8%. We've all been in that trade for a minute, but this was by far the largest one-day gain I've ever had. Marcus Holloman was right. The 4-hour doesn't trade often, but when he does, it really brings home the bacon. At the time of that post, the system showed $33,762 in profit just for the day and $153,611 in total profit across 4 active bots. Now, that wasn't a fluke and it wasn't the result of one risky bet. It was the outcome of a system that's designed to handle size, manage risk automatically, and operate the same way whether it's trading $10,000 or 7 figures. And this isn't something that I reserve for clients only. This is the system that I actually run on my own capital and my friends and family's capital day in and day out under the same rules with the same risk controls. It's been deployed across multiple accounts through different market conditions and refined over time, not in theory, but in actual live trading. So to understand why this works, we need to step back and talk about first principles. Because in physics, systems don't survive because they're aggressive. They survive because they respect constraints. And markets are no different. Most traders fail not because they're unlucky, but because they violate basic structural laws. They over-leverage, they chase price, they panic, they improvise, and they rely on emotion instead of design. Now, the system we've built is built on 3 core principles that allow it to function safely at scale. Let's go through these principles now. The first principle is how we use DCA, dollar cost averaging. Now, most people think dollar cost averaging is about buying blindly. Now, that's retail DCA. It's just emotional, mostly reactive, and sometimes even dangerous. Institutional DCA works very differently. In this kind of system, the initial position is always deliberately small. It's not a prediction. It's simply an entry when the market presents favorable conditions. If price moves in its favor, the trade resolves quickly and profit is just taken. Nothing else happens. But if price moves against the position, the system doesn't panic. It doesn't double down emotionally. It executes a predefined sequence of safety orders, each one planned in advance, each one sized intentionally, and each one placed at an increasing distance as volatility expands. This is the most critical part. DCA here is not how the system makes money. It's how the system actually stays alive. It's how it breathes into the trade. By spreading capital deployment over a wider price range, the system is going to lower its average entry price. It's going to reduce liquidation risk and give itself more room to operate even in sharp drawdowns. There's no improvisation, no hope, just math and structure. And that's what allows this system to manage large capital without blowing up. The second principle is understanding market structure, specifically the Wyckoff cycle. Now, the Wyckoff cycle is a first principle because it describes something structural about markets. It's not a trading strategy or an indicator. And markets move the way they do because large participants can't buy or sell all at once without moving price against themselves. So they're forced to operate in these phases, building positions quietly, pushing price when liquidity allows, distributing risk into strength, and eventually allowing price to reset. This process repeats at every time frame and in every market, which is why systems built for serious capital don't try to predict direction, but instead they adapt to whichever phase that the market is in. So the algorithm responds to volatility, liquidity, and price behavior as it unfolds. And that's why when it does trade, the outcomes tend to be more meaningful. As the client said himself, the 4-hour system doesn't trade often, but when it does, it brings home the bacon. The third principle is where this system diverges completely from traditional trading logic. Most quantitative trading strategies rely on mean reversion, the idea that price eventually is going to return to an average. This approach made Jim Simons one of the most successful traders of all time, earning roughly 66% annualized returns through the Medallion Fund. But Bitcoin is not a normal financial market, and Bitcoin doesn't reserve to some kind of flat mean. Over long periods of time, Bitcoin follows what's called a power law, and on a log chart, this looks like a straight line, and this is driven by adoption and network effects. So treating Bitcoin like a normal asset is actually a mistake. And that's why instead of mean reversion, my system uses power law support as its structural reference point. And working alongside physicist Giovanni Santastasi, we treat the power law not as a prediction, but more like a compass. And we don't rely on it to take profits. We simply use it as a guide and a framework. It tells us where the long-term structural support exists. And the power law support acts as the system's first true line of defense. Everything above it is exploitable volatility, price just moving back and forth, creating opportunities for systemic income generation. The algorithm doesn't fight Bitcoin's nature, it actually works with it. And when you combine all three, disciplined DCA logic, adaptive market Wyckoff awareness, and a power law-based framework, you get something extremely rare that we've built. It's a system that doesn't rely on prediction, it doesn't rely on emotion, and it's a system that can scale safely into 6 and 7-figure territory. That's how a result like $153,611 happens. Not magically, but through structure, discipline, and respect for how markets actually behave. This is how institutions trade. And now for the first time, these systems are no longer locked behind closed doors. And this is where most conversations around trading bots completely miss the point. If you spend any time online, you'll see endless reviews of bots being tested with $1,000, sometimes $10,000, and the results look exciting on the surface. But those tests don't actually tell you anything meaningful. Most of these bots are mechanical, and they're not even truly algorithmic. They follow fixed rules without understanding market structure, volatility, or risk at scale. And because of that, they're not designed to be trusted with serious money. Take a look at these guys. They're testing and reviewing these bots that they have no idea what are the engines behind them. And this is why they're only using $1,000 or $11,000, because they don't trust them with more money. And I wouldn't either. A system that works on a small account can fail catastrophically when capital increases because the constraints completely change. And if you have no idea what the constraints are and how the system was built, how can you trust it with large amounts of money? Drawdowns matter, risk compounds. If your goal is to grow at scale, not just to experiment, the only question that matters is whether a system is structurally sound with 6 and 7-figure capital. Because running a bot with $1,000 won't make you wealthy. What does is having a system that you can grow comfortably running at 1 million, 10 million, even 100 million or more, knowing it can survive long enough for growth to actually compound. And the reason I trust my system and the reason my clients trust it as well is simple, is because I built it. I understand the principles it's based on. I understand the logic behind every decision it makes. And I understand the code that's executing those decisions in real time because we wrote it. There's no black box here. And when someone becomes a client, that understanding is shared with them. They're not just given access to a tool, they're shown how it works. They're talked through it. They're given the education. They understand what risks it's designed to manage and what constraints it operates within. That education is all part of the process. And it's what gives people the confidence to trust the strategy and stay disciplined when the system is doing exactly what it's designed to do. And that's why I can sit comfortably inside a $1.2 million position like the one you can see in a video posted a few weeks ago. You take a look at it on the YouTube channel. Because when you step back and take a look at the numbers we started with, a $33,762 day and a $153,611 account in profit generated without manual trades and without emotional decision making. The question isn't whether results like these are possible, because you've already seen they are. The real question is why they were possible. Was it because someone watched charts more closely? Was it because they worked harder? Or because they guessed the market better than everyone else? Or was it because execution was automated, risk was defined in advance, and the system followed the rules regardless of noise or emotion? And if that's the case, then it's worth asking yourself something simple. If you're serious about deploying capital over the long term, does it make sense to rely on discretionary decisions made under pressure, or in a system designed to operate consistently at scale like ours? Or would you prefer to try some black box that you completely have no idea what kind of engine it's running? And if your goal is to grow over time, not just experiment with small amounts, shouldn't the strategy be something you'd be comfortable running where the numbers are much larger than they are today? If those questions resonate, the next step isn't to commit to anything. It's simply to have a conversation, to look at your capital, your goals, and whether an automated algorithmic approach like this actually fits what you're trying to build. And if it doesn't, we'll tell you that on the call. But the only way to have that conversation is to book one first. So you can do that by using the links below this video. And we look forward to talking with you really soon.